Welcome to this deep dive, where we're cutting straight through the noise on the Q3 2025 earnings call for CMB Tech.
And this is a fascinating one.
It really is. We're looking at a company that's in the middle of a complete metamorphosis. They're moving way beyond their old crude oil tanker roots.
Right, into this huge, diversified global shipping and technology player. And that's all thanks to the scale they got from the Golden Ocean merger.
So our mission today is to filter out the critical nuggets, not just the numbers, but, the strategic shifts and the outlook for Q4 and beyond.
Exactly. It's this new balance we have to understand. You've got the super cyclical freight markets on one side, and on the other, they're long-term structural decarbonization plays.
Okay, so let's just unpack this right away with the headline numbers that dropped before the market opened. There was a big disconnect, right, between that revenue number and the net profit.
That's the perfect way to frame it. The underlying current was really positive operationally, but those top-line signals, they caused some confusion at first.
So where do we start?
Let's start with the massive beat. Revenue came in at $454.2 million.
Wow.
I mean, that's a staggering 105% increase year over year.
105%. That's, how much did that beat expectations by?
It just crushed them. The street was at about $393.4 million, so it beat that by a good 15, maybe 16%. This wasn't a small beat at all.
And that's the signal, right? The merger benefits are flowing straight to the top line.
It is, and you see that operational leverage showing up in EBITDA too.
Okay.
Non-IFRS EBIT, so, excluding some of the one-off accounting stuff, it came in at $238.4 million.
And that's up how much?
That's up a very, very robust 35% year over year. So the proof is right there. The combined company is generating a ton of cash from operations.
But the initial reaction was all about that net profit number. Tell us why that looks so disappointing on the surface.
Right. So net profit landed at just $17.3 million, which is a painful 82% decline year over year.
Ouch.
And that sounds awful in isolation, but management was quick to clarify. Two key things. First, higher interest expense for the acquisition financing. That's pretty natural.
And the second?
The second, and this is crucial, they didn't have the big non-recurring capital gains that they booked in the same period last year. So that comparison was kind of artificially inflated.
So if you strip out those technicalities, what did the EPS look like?
The GAAP EPS was 0.07 cents. That was in line with what the company expected. But it did miss the higher consensus of 0.11 cents that some places like MarketBeat were citing.
So to sum it up, huge revenue beat, great operational strength, but the bottom line got messy because of merger financing and accounting.
Exactly. But even with all that volatility, they immediately rewarded shareholders.
The dividend announcement. That was a key part of the opening.
Absolutely. They proposed an interim and special dividend of 5 cents per share. And that's a strong, concrete signal that, the underlying cash generation is already there.
It's not just a future promise.
Right. They're proving it, even in what they themselves called a transition quarter.
That phrase, transition quarter, is the perfect bridge. Let's dive deeper into the strategy. They really used Q3 to set a narrative, didn't they?
They did. They admitted Q3 was a transition, a soft summer where rates were seasonally lower. But the whole forward-looking message was totally different.
It was all about Q4.
All about Q4. The dry bulk and tanker markets are already, in their words, roaring back. And with the new scale of the company, they are just perfectly positioned to catch this wave.
And that scale is just transformative. Remind us, what's the new reach of the company now?
Post-merger, CMB Tech is massive. We're talking a fleet of roughly 250 vessels.
Wow.
Everything from dry bulk carriers to chemical tankers, new energy vessels, you name it. They're managing about $11 billion in assets. And critically, this gives them way more spot exposure to those rallying markets.
So they're highly leveraged to the upside.
Extremely. But it's not just about passive consolidation. They're actively managing this new fleet.
How aggressive were they in Q3?
Very active. They took delivery of 7 new builds, the new efficient ships, and at the same time sold off 2 older ones. Their focus is super disciplined.
Right.
They want to sell any ship older than 15 years as long as the secondhand price is high. They even cited selling 18 or 19-year-old VLCCs.
The big super tankers.
Exactly, the very large crude carriers for over $50 million each, which is just an incredible price for ships of that age.
And they signal that's going to boost Q4 earnings too.
Correct. They expect to realize another $50 million in capital gains from asset sales just in Q4 alone. So that'll help that net profit line we were talking about.
Okay, but here's where we hit the absolute core of the investment case. The number they kept talking about, that theoretical free cash flow capacity. That $250 million per quarter figure. I mean, that sounds almost too good to be true.
It is the centerpiece of their pitch, and you're right to question it. That number, $250 million of FCF capacity per quarter, it's based on the assumption that these current very high spot rates continue.
But wait, their remaining capex, the money they still owe on new ships, is $1.57 billion, plus a new vessel they just ordered. How do you generate $250 million a quarter and pay that bill?
And that's the genius of the tying, right? The merger timing aligned perfectly with the cyclical spike. That $250 million, if they realize it, is enough to service that massive capex bill and deleverage the balance sheet really, really fast.
So they can do both at the same time.
They're planning to. They expect to fund the capex and pay down the expensive bridge financing from the merger by $300 million in Q4 alone. The velocity of the cash flow is just that high.
And that rapid deleveraging is so important, especially when you think about their dividend policy. What's their official stance now?
They hammered this home. It's a fully discretionary dividend policy. And that's key. There's no fixed minimum payout.
So they can be flexible.
Totally. They're balancing shareholder returns with keeping the balance sheet strong, making sure they have cash for M&A or new energy projects. It signals real confidence in their growth options.
Okay, let's pivot from finance to the market's actually generating all this cash. We need to get into the segments. Contrast the bulls from the bears.
The strength is just overwhelmingly in their legacy businesses, tankers and dry bulk. For dry bulk, I mean, the fundamentals look incredible.
What's the key metric there?
The order book to fleet ratio for the big ships, the Capesizes and Newcastle Maxes, is only 9%. That is structurally very, very disciplined supply.
And a low order book means few new ships are coming to, well, ruin the party. And we're seeing that show up in the Q4 bookings.
Absolutely. Q4 rates are accelerating fast. Newcastle Maxes are fixed at $34,000 a day, Capes at $26,200. Way higher than Q3.
And tankers are even stronger.
Even stronger. Q4 VLCC bookings are at a massive $68,000 per day, with 78% of the days already covered. Suezmaxes are at $60,000.
But does the tanker market have that same supply discipline?
That's the one little cautionary note. The VLCC order book is a bit higher, around 15%, and Suezmaxes are at 20%.
So more supply coming.
A little more. Management says it's manageable because the global fleet is pretty old, but it's something for investors to watch more closely than the dry bulk side.
We also heard a specific trade detail supporting demand for those big ships, the Simandou project. Why is that relevant?
Right. Simandou in Guinea is a huge new iron ore mine, and it's expected to replace short-haul Australian trade with much longer-haul trade from Guinea to Asia.
Longer routes means you need more ships.
Exactly. It structurally supports demand for the larger vessels and helps keep those rates high.
Okay, now let's switch gears to the cautious segments. Containers and chemicals. What are the risks here?
Management is explicitly cautious on these two, especially containers. The container order book is enormous. We're talking 32% of the existing fleet is on order right now.
That is a supply tsunami.
It is, and it's set to hit the market starting next year. And that's compounded by the fact that the Red Sea diversions could start to unwind.
Which are currently helping them.
Precisely. Right now, ships are going around Africa, which boosts ton miles by 10 or 12%. If that normalizes and you add the 32% order book, the market just looks structurally weak through 2026.
Okay, and finally, let's look at the growth engine. The offshore and decarbonization division, Windcat, what's happening there?
This is the consistent, long-term growth story. The new CSOV vessels.
The ones that service the wind farms.
Right, the construction service operation vessels. They're getting high Q4 rates of $118,000 a day.
And they just ordered a new type of vessel that shows some strategic thinking.
Yes, the MPASV. That's the Multi-Purpose Accommodation Service Vessel. It's a bigger CSOV designed for maximum flexibility. It can work in offshore wind or in the traditional oil and gas market.
So they're hedging their bets.
Exactly. They're designing assets that aren't dependent on a single energy transition cycle.
This all loops back to the big picture, the energy transition strategy and how investors should think about the risk here.
It connects everything. They reiterated their firm commitment to ammonia and hydrogen as their core decarbonization fuels, and they explicitly are not prioritizing LNG.
What about the delay in the IMO carbon pricing rules until 2028? You'd think that would be a setback for them.
You would, but they said not at all. And this is a huge differentiator. Their strategy is driven by commercial tech development and deals with partners, not regulatory deadlines.
So the IMO rules were just a nice to have.
A nice-to-have tailwind, not a must-have requirement.
Which brings us back to the core challenge, this huge divergence in sentiment around the call. How do you square management's optimism with all the skepticism?
The gap is stark. Management is telling a multi-year decarbonization and FCF compounding story. They see themselves as a transitioning infrastructure player.
And the other side?
The other side, the consensus sell-side ratings, they're still cautious. They still see a cyclical ship owner with a lot of debt and execution risk. They're pointing to the high interest costs and the CapEx bill.
And yet the market might be starting to come around. We saw some technical indicators suggesting momentum.
Exactly. The Investor's Business Daily RS rating, the relative strength rating, it's climbed up into the low 80s. That suggests the stock is showing impressive strength relative to its sector. Buyers are stepping in.
Okay, let's shift gears now into our final segment. This is where we lay out the outrageous but plausible trade idea based purely on the insights from this call. And remember, this is not financial advice. So if you're pitching this to a committee, what's the thesis?
The thesis is simple and it's aggressive. Initiate a long position on CMB.Tech. The bet is that the market is structurally undervaluing this transition platform relative to the cyclical noise, creating a huge short-term opportunity.
Okay, what's the justification? It has to be more than just rates are high.
The justification is all about the velocity of the cash flow. That $250 million in FCF per quarter is going to structurally deleverage the balance sheet toward their 50% loan-to-value target much, much faster than anyone is forecasting right now.
So the cash is basically eliminating the risk at an accelerating pace. What's the specific catalyst that forces the market to re-rate the stock?
The dividend policy is the catalyst. Because it's fully discretionary, the sheer volume of cash coming in forces management's hand. They have a binary choice.
What's the choice?
They either have to conduct really aggressive share buybacks, or they have to significantly hike the special dividend payout in Q4 or Q1. And that forced capital return is the mechanism that compels the market to change its mind.
And shift the valuation away from cyclical shipping toward that green infrastructure premium.
Precisely. The market is pricing risk, but the incoming cash is just erasing it quarter by quarter.
That's a compelling pitch. So what's the one thing that stands out to you about this whole divergence that our listeners should really take away?
It's just how rarely you see a company successfully integrate this high cyclical leverage with high structural growth optionality in one package. They delivered strong results in Q3, they're positioned for a huge Q4, and they're pushing that capital-intensive hydrogen story forward all at the same time.
And that leaves us with a final, provocative thought for you to mull over. We heard management say they're working to optimize their financing and reduce their $2 billion debt cost by over 100 basis points in 2026. So what structural change will ultimately have the greater long-term impact on this company's valuation? The immediate, headline-grabbing boost from high spot rates that gives them cash today, or the quiet, persistent work of streamlining that balance sheet and optimizing their cost of capital for years to come?